Hey there, this is Kai Whitney of Redbridge Capital Consulting, and I wanted to do a follow-up on the free white paper that you had received titled Auction Market Theory. I know lots of things that are involved in trading have a lot to do with analysis and theory, but I wanted to particularly put this AMT theory into the process for you and give you kind of a step-by-step analysis on how not only did we come up with buying the bottoms back in December and following through in January, but also how we monitor the commitment of traders reports from the CFTC, how we monitor smart money, including bond, short-only funds, hedge funds, private equity, and the like. And I'm going to finish with a perfect example from today. So I outlined it in this report that I'm going to share with you, but I'm also going to share a trade today based upon basically putting into practice auction market theory. And here we are. So if we're going to go to the video of today is February 21st. This was a short trade. Now it's only a 5-minute video. Let me set the stage here for you. Okay, so we're working with the S&P 500, and we see that we rejected off of these higher levels where you see on the left-hand side it says trap, see SQD, reversal trap, no buyer, SQD trap, SQD, no buyer. Then we're seeing a test, and this test is met with a lot of delta. So this delta is basically an imbalance of buys versus sales. It's the net difference. So what you're trying to do then is you're trying to gauge the reaction, the price action of this upward momentum and see if it fails or not. Or in this case, using auction market theory as the market's trading up to see if the sellers actually are truly going to sell the market today. So you can see here where I started the video, we see I have one single contract in, and right now it's a P&L of $25. Now this is entered in at $27.78. It is actually after the fact. So this actually was a trade that was late. I have students that were taking the trade back up in near the 79 half, but that's here nor there. Let me follow through with this. You'll notice that what I'm going to do is I'm going to initiate the trade based upon the responsive selling that occurred leading up to the actual trade following through, which we're going to call initiative selling. Now, these are terms that you're going to find in the auction market paper. Okay. So what I'm doing right now is I'm probing the market to see if it's going to accept this trade. It shouldn't take me into a negative. So the idea that if, let's say you're a 5-contract trader, okay, the idea is you don't want to put all 5 contracts at risk on a trade. You want to probe and leg into that trade as it continues to work for you. So let's see how this develops. Now you're going to find that this is going to run for about 3 minutes with a single contract on. And what I'm doing is I'm clearing the dome here of the imbalances and the sales. So what you're seeing is actually, let me pause. I'm showing you here, this is a filtered block trades of greater than 164. To the left is the order flow sequence tracker that I had developed, and the acronyms here are, it's kind of like a training wheel process where it's kind of telling you what the orders are doing. If there's a buyer involved, if there's a seller involved, if there's a potential trap being set, if it's a potential reversal, et cetera, et cetera. It's a learning curve through this process, but it will lead you over to the far right. And this is the price ladder. This is the S&P right now between 2782 half is the high right now, and 2772 half here. And then on the left-hand side in green are the indications of interest. Those are limit orders to buy. The second column of green are the additions and the subtractions of those limit orders. So for instance, if someone is coming into a trade and they are really interested in trading, they are going to add to this contract, and you would expect if you see 126 add, 196 add to equal 188 and 168, then you would expect to see much larger than a 2 lot. Okay. On the other side are the sellers. These are those that are interested in selling, and you can see that they're really interested up here, 113, 101, 318, up through the 79s, which was the initial rejection. So What I'm doing now is I'm testing to see if I'm properly positioned. And what I'm expecting is that if these ads are for real, I should see much larger size come through on the buy. And if you see on the left, I'm pointing here to the filter tape, you can see at 27.78, there was a 209 buy. So that is where I am. I'm in my first lot at 27.78. And so what I'm doing now is I'm testing the 209 at 78, because obviously we're trading lower, 77.50. Now, if this was a true imbalance, a buy imbalance, then the trade should be heading higher, specifically since all of this here is showing that they're still interested in buying. So let me continue with this, and you'll see it run through. There's a 225, 233. That's good. So what we're seeing is an uptick. And now what we need to see then, if this is a long, I would obviously scratch out if we trade through 78 into 78 quarter and see more of this size occurring. But we see 252 right now, and we only upticked 1 and no seller. So if there really isn't a seller in the market, this would go right straight bid back to probably 27.80, the value area high. It is not. I adjust my stop to 79, assuming that this is going to be at risk, and so there's no reason to continue. But then we see that trade away, and we see hit the bid of 25, I believe that was, and then 6. Now we're starting to see them cancel, but we still see 256 at 77 quarter. Now what we want to do is we want to watch this to see if it firms and they start bidding again and hitting into the ask, buying big orders. And if that is the case, then this should uptick more than one tick. But so the reason why this is doing so, we continue to see more and more and more add, but they're not executing. So there was only a 1 lot executed. More, I think that was about 18 more, but they're showing 210. And the asks here are getting out of the way, allowing for this move to trade up. But we're not seeing that. So let's go to the far left now. And this is the order flow sequence tracker. So we see 2006 that printed at 78.5, and that's a buy imbalance. We see new incoming orders of 877, 992, but we're down ticking. So once we see this clear and go negative, I believe I start to add to my one contract. So it went neutral. The sellers absorbed the buyers. And we see a couple trades here. Now these are all much smaller, but we're still waiting for these to trade and cancel. So we're starting to see a little push through. Now we're going to expect that we're going to trade back up to that 113. And then if we fail, then we'll be able to add the contracts. But the importance is obviously leverage in when you're trading in the markets. And it's also trying to take minimal risk. So I did add, I'm 5 contracts now short based on the information that we're seeing here. And my stop is 2 points higher, but that is just a hard stop. What I would do to cancel is if I saw this go big, if everything started to get much, much larger than it is now, and we start to see those 200s, those 300s, those 400 prints again, and then price start to trade up, I would go ahead and cancel and take a couple tick loss. But the key here to notice is that by the time I am 5 lots short, my negative is $25. Okay. Now there's going to be, let's see, we are at 4 minutes now. And this is only a 5-minute video, so I am going to have to pause this before I'm going to have to pause and repause as we see new levels happen. But notice that 5 contracts, I believe it was negative $37. So technically, I was never off sides in this trade. And the goal, I'll show you the end result, but the goal is to trade to the point of control. That's the first level of trade. So you'll see here 27.73 half, volume point of control. That's the first trade level. So we're now plus 725 on 5 contracts. And we're starting to see how all of the bids here are much, much smaller, and they've canceled, right? And the sales are adding, and they're also printing larger, much larger than the buys. So that had to cut short there, but let me run into, I'll show you the setup. So the setup is as we opened, we traded down, the long down here, up to test into the value area low of the previous day at 27.81. And then responsive sellers came in to push it lower, okay? Then it traded back up, responsive sellers sold again, and what we're looking for is not just responsive sellers, but initiative sellers to sell into or back into value through into the point of control, which is the point line, the magenta line here, and then potentially lower. And so here you see at 27.78 is the entry. And you'll notice on this next here, at the first at 73.5 and just through 73s, I was able to pull off 3 contracts and remaining 2. And so what I did after that is I just followed the 2 contracts behind. So when you see a cluster of large sales, and then basically price fall, then you see another cluster, price fall. What you want to do is you want to move, here's my stop here, you want to slowly move these behind each level, waiting for the market to take you out. Now you can see that again, 78 was my entry. 77 quarter or so was when I got all 5 contracts on. And then we let it trade into the point of control. Took a few off because we got a little bit of a pause. You can see here as you get to 73, half, and 74, look at all the volume that came in here. 1683 on a bid, 2978 on the ask. 2871 on the bid, 1830 something on the ask. 2395 and 1548, 2065 and 1661. So obviously a rotation happened here, and the sellers did win this. So there was reason to hide behind and keep the remaining 2 all the way down through the lows of the time, value area lows. And we ended up trading all the way down to 27.70 before we found responsive buyers. And then the market took me out here at 150. So again, the key on this in the auctioning process is let me go through this here, is going to be looking at whether you're initiative buying, initiative selling, responsive buying, responsive selling. And in this document here, I go through the process of using or tracking smart money institutional order flow and the reasons behind getting either long or short in the market, using reportable documents from the largest traders in the COT, as well as tracking smart money institutions, hedge funds. And you can see here where we have, this is a chart made up of private equity, insiders, hedge funds, and bonds. These collectively are the smartest minds on Wall Street. What you're going to do is these are the December highs when they started doing a responsive sell here. Then they initiated sell. Then the buyers came in responsive buying, fail, initiative sale, responsive buying again on the 18th of December, fail. Then the 24th low, we start to get responsive buying again. And then finally it breaks through and initiative buying. And every time up, we're seeing responsive buying, responsive buying, responsive buying. And now that we're up at these levels above December highs, these institutions are no longer going to press for larger positions. They're going to manage their risk, manage their profits basically here, which means that if there is a reasonable pullback as we're getting today in the market, they should defend these buys by adding or buying on the pullback. And that's exactly what we should do. So again, I just wanted to put a little trade to the auction market theory white paper. Hopefully this will help give you a little more insight onto the process in the mentoring. And if you have any questions, feel free to reach out to me again, info@imftracker.com. If you'd like, you can go to the website under private mentoring. We'll do this all in live markets. We'll do this step by step, and we'll start with the foundation of the auction market process and valuing the markets as the institutions do. And then we'll learn to track responsive and initiative trades and be able to trade with them, as in the example, starting small but adding when there is no risk, or never letting a trade really take you out of the game is the key. Because trading is all about leverage and managing risk first. It's not about scalping and trading all day, every day. It's about finding trade locations based upon the auctioning process. I hope this helps. Again, it's Kai Whitney, and we'll talk to you soon. Thank you.